Good morning, everyone. My name is Geoff Wilson. I'm the chair of Wilson Asset Management. Thank you very much for coming along. This is our 39th presentation or conversation with our shareholders over the last 20 years. And it's great to see a lot of familiar faces, and thank you for your loyalty over that period of time. You allow us to do what we love doing, and we're very grateful for you to allow us to do this, everyone at Wilson Asset Management. And your loyalty, as you're loyal to us, then we understand it's important that we are loyal to you, and we stand up for you, openly, actively. One area that we've been doing that more recently is on the with a various an opposition policy to do with franking credits. Now, in terms of before we look, thank you. Just to make it clear, we are bipartisan, and we were very focused on the policy here. It wasn't on the politics. If the coalition had come up with this policy, we would have lobbied as hard against that as we did because Labor came up with it. So I just wanted to make that very clear. Also, in terms of the policy from our perspective was illogical and significantly inequitable. Illogical because the great thing about the franking system is that it encouraged money to go into Australian companies to employ Australians, to pay tax in Australia, and then to pay fully franked dividends to Australian residents, and to allow companies to be re-rated because if they do that, and then reduces their cost of capital. So it was a very logical, efficient system. And when you start dismantling that system, it has significant negative impacts. The other part was the phenomenal inequity of the system. Of the proposal by Labor, where you had a group of shareholders that are retired, that have worked all their life and done the right thing and operated under a system for nearly 2 decades, and then Labor saying, we're going to focus on the self-managed super funds and the individuals, and we're going to take those franking credits away from them, which people are, it looked like it was about $6 to $7 billion. But say the same person who's retired happened to have their money in an industry fund or a union fund, then they would get their franking credits. Now that was just totally inequitable. And in terms of the pain that it's caused you all, all Australians that had done the right, had really performed and done the right thing for Australia, was significant. And it reminds me, an email that we received on Sunday from one shareholder was just saying how for the last 18 months, since Labor announced this policy, every night he'd woken up between 3 or 4 o'clock, and every day he said that he worried about how he's going to make up that $14,000. And he said Saturday night was the first night that he slept through. But we understand the pain. And thank you all for sending your stories to us. And thank you all for supporting us and standing up. And in terms of, you might have thought we're a bit extreme 6 months ago when we had the placards, but our goal was to get franking on the agenda. And we're very happy that people did understand it. It was a complex issue, and they voted accordingly. And I think one thing that Labor underestimated was the intergenerational impact that, that this change was going to have. And we did a survey, and thanks for everyone who came back on that survey, of the people that signed the petition, and 47% of them, this is all voters, Liberal, Labor, Greens, etc., 47% of them said that their children or grandchildren would change the vote because of what's occurring. And like 2 days ago, we've been doing our 6-monthly roadshow. 2 days ago, we're in Brisbane, and one of our shareholders, he stood up and he said, I've got 11 grandchildren and 3 great-great-grandchildren. And he said 7 of them were in voting age. They were between 18 and 24. And he said, I sat down with them 5 times and explained how I started putting money in superannuation in 1959 and the taxes I've paid and what this Labor policy was going to do to me. And he said all of them changed their vote. And so I think that's what was underestimated. Now, this has only been possible because we've all worked together. And I want you, I think, we have to celebrate a little bit. So I'd like you all to stand up. If you can all stand up. Can everyone from Wilson Asset Management, because this was a team effort. You think I did, I'm the one that makes the noise, but everyone else is doing the hard work behind me. So can everyone from Wilson Asset Management come to the front? Can you please, no, not just yet, we're going to have it, can you go between the aisles? Okay. Few more here, few more. Hey, we need some more down there. Okay, guys. Now, what I want everyone to put one hand up, and I want everyone, either the people beside you or someone from Wilson Asset Management, I want high fives. Come on. Come on. Well done. Come on. Well done. Well done. Well done. Well done. That's great. There we go. Well done. Thank you. Thank you. Thank you. Thank you. That's great. Thanks, guys. I mean, it was unbelievable, and I think it's important to celebrate our wins. You've all, when you came in, you all picked up this bag, and you'd be happy. And again, it is your company, and we're here because of you. So thank you for your feedback. A few people said last year the bag, the bottom was was one of those little. It didn't have a wide bottom, so for you, instead of paying 99 cents at Woolies, you can use this bag, which has got the new improved wide bottom. I think at no extra cost. And if you look in here, there's various things about the investor forum. If anyone wants to, we'll be staying around later, and I think we've got about 1,000 people coming to that as well. But in here, you've got various things about investing in the future. So please look through that. But one thing I want to point out is in here, we all ran the petition, and thank you everyone for signing it. And of course, we put these bags together before the roadshow last week, so we thought we were going to try to get you to sign the petition again. Now, can everyone find the petition? In the bags, can you look into your bags? It's in the middle of the little book. It's the one with a picture, and again to show how we're bipartisan. It's a picture of Scott Morrison and Bill Shorten. Actually, you might want to keep it for history. If you can all, please. Has everyone found the petitions? Okay. So. Now, I want you all to stand up again. Now, everyone's got their petitions. Now, this is the cleansing. Okay, you got the petitions. What I want you to do is put a hand on either side, and I want you to rip them in half. And now, what I want you to do is throw them in the air. Hey! How good is that? It's over. Hey, leave the piece of paper on the ground. It's like a wedding. Like in Brisbane we did it, and I think it's important. Now, in terms of the serious stuff, that's so you don't sue us. The disclaimer, can you please read that quickly? Thank you. I think the franking update, because we were convinced that the franking policy by Labor was going to be blocked, and we'd already started. We had a meeting with two of the Centre Alliance senators in Adelaide, and we're systematically planning on working with all the crossbench senators who had said they were going to block it to make sure it was blocked. So at least that's a little bit of work we don't have to do. Actually, before we finish off on franking, James McNamara, can you please come up here? Thanks, James. I'd like to thank our corporate affairs, shareholder communication engagement that's led by James. Also, Vincent So and Emily McPherson, please, thank you. Well, we'll just leave James up, but thank you for your work. Vincent So was the one who decided on the petition, and this was a campaign. And when Labor announced it, we decided to run a campaign. I know that I noticed a couple of days ago there was a big article about Andrew Hurst, from the coalition. What an incredible job he did. On behalf of everyone, I'd just like to thank James McNamara for running the campaign for us and doing all the work behind the scenes. Thank you. On behalf of everyone in Australia, thank you. Thanks. Where are we? 6 months ago, I was very nervous. When I was talking to you. Why was that? There were three factors. One is global growth was slowing. So in theory, if earnings growth is slowing, then that's negative for share prices. Secondly, interest rates in the US were expected to increase. And we know there's an inverse relationship. When interest rates go up, valuations of companies come down. And that was the second reason. And the third reason, which was the one that concerned me the most, was the US had started quantitative tightening. And they've been doing it for over a year. They started taking $10 billion out of the system and they're up to $60 billion. And quantitative tightening was the reverse of quantitative easing. We saw after the GFC, $15 trillion was pumped into the global markets, and so valuations went up. And with quantitative tightening, the expectation was the US was going to take $3 to $4 billion of liquidity out of the system. And we all have had a little taste of what happens when you take money out of a system with housing in Australia. And I was of the view that the market could easily fall 30 to 40%. And I thought it would bottom. The good thing about bear markets is they tend to be short. I was thinking at the end of this year. Now, my prognosis was wrong because the Federal Reserve did a total U-turn in terms of stopping quantitative tightening and halting interest rate rises. Now the expectation this year is actually an interest rate fall in the US. And also we had China. They pumped, I think in January, February, over 6 trillion RMB into the system. So effectively they started quantitative easing. We actually, for those that have been around a long time, they know sort of our rule number one is don't lose money. Rule number two is don't lose money. And so is rule number three. I suppose because when I started this business, I put all the money I had, $500,000 into the fund. So that's how we manage money. So with WAM Capital, WAM Research and WAM Active, which look at smaller companies, and WAM Microcap, we increased our cash levels because you have to do that over time to a high level, which probably it negatively impacted us. When the Fed changed their mind. With WAM Global and WAM Leaders, they're in a lot more liquid companies, So they didn't need to increase our cash levels to such a degree. So where are we now? Looking forward, we still are in the latter stages of the longest bear market ever in the US. But in terms of the outlook, the longest bull market. Exactly, the longest bull market ever in the US. We're getting very close to a bear market. But what are we? So what are the factors? Interest rates are probably coming down domestically and internationally, which supports valuations. Quantitative tightening is off the table. And so the risk is really specifically on earnings growth, and we're aware of that. So it appears to me that the can's been kicked down the road a bit further, and we are nervous because we're in the latter stages of the bull market, but we are still taking advantage of various opportunities. And you'd have seen at the end of last month, we'd increased our cash levels. We'd reduced our cash levels significantly, and we started doing that pretty much at the start of January. So in terms of going forward, still cautious, looking for really making sure we don't have any companies that have earnings downgrades, and believe the market probably will be all right over the next period. In terms of LICs, premium and discounts, it was interesting. One of the areas we talked about, this is a year ago, when we're trying to get the franking debate on the agenda, was the negative impact that this policy would have for all Australian workers. And we saw that on Monday when the banks rallied to the extent they did, because what had actually happened is a lot of people had started readjusting their portfolios and they've been selling. And one of the things we found also is there's been a buyer's strike. I know a person that signed a petition that rang up the office last week and said they're coming along today and they're interested in what we do, but they're not interested in buying any of the entities we manage until the franking debate is off the table and has been resolved. So people don't like uncertainty. And in the LIC space, the biggest LIC at December last year was trading at about a 5%, that's AFIC, was trading at a 5% premium. And last week, it was down to about a 4.5% discount. So that's the largest. It had moved about 10%. And as I mentioned, we saw the relief rally in the banks. The banks are owned, I think, by SMSFs. About 30% of their register is by SMSFs. So from our perspective, the whole sector goes back to equilibrium. The LIC space, which was in a golden period, as of 18 months ago, goes back to that status. Because it's a great, they're great products, and I think. And obviously there's no selling pressure and the buying strike is over. So we've obviously felt some of that impact in our various entities, but to me that's finished. Now what I'd like to do is pass you over to Catriona Burns, who is the lead PM for WAM Global. Thank you.
Thanks, Geoff. Good morning, everyone. When I spoke to you last in November, as Geoff said, we were cautious, but I talked about two factors that we thought needed to change to get more bullish on markets and for the longest bull market in history in the US to continue. And the first of those was an unexpected change in the US Federal Reserve's ongoing policy or program of interest rate rises and quantitative tightening. And the second was a resolution to the US-China trade war. Now on the first, we had just that. In December, the Fed increased rates, and was still saying that they would the expectation was that they would still raise rates a further 2 times in 2019. But by January, they were saying they'd gone on hold and that quantitative tightening would be wound down. In terms of why the Fed did a complete about-face, we think there were a number of factors that led them to that outcome. Firstly, as you can see from the chart on the left, global growth was slowing down through 2018 in major economies like Japan, Germany, and China. The US, and this is a chart of purchasing manager indices, which anything above 50 indicates expansion. So the US, while still expanding, it was happening at a decelerating rate. So there was concern that the global growth slowdown would feed through into the US. Secondly, you had a US government shutdown underway. Thirdly, as you can see from the chart on the right, financial conditions had tightened in the US. So you saw corporate bond yields had spiked, and there was concern that the Fed had already over-tightened. And lastly, inflation in the US wasn't a concern, so it wasn't consistently above the 2% level that they target. So they had a mandate to be able to go on pause. And the equity market volatility that we saw in the fourth quarter was able to be, you saw that completely change on the 24th of December, the market bottomed, and since then we've seen a really strong rally since. Now the debate is obviously where to from here. And if you look at the US economy, the dual mandates, as I said, of the Fed, firstly, maximising employment and stabilising prices. On the first of those points, employment, US unemployment rate is at 48-year lows at 3.6%, and the labour force is very tight. Available workers exceed. There is less workers than jobs, so there is an extremely tight situation in the labour force in the US at the moment. On the second point, in terms of inflation, it saw on the April print, it was 1.6%. Now, the Fed has a mandate for it targets a 2% inflation rate, and you've seen it consistently below that level. We think the real concern for markets at this point is that inflation does tick above that 2% level, because if it was consistently above that, the Fed would have to reconsider the policy at the moment of being on hold. So for us, a key watch point is what happens to inflation. Anecdotally, I've been in the US, many times over the last year, and each time I go back, there is more and more complaints from companies about how tough it is to get workers. And if you've got children looking for a new career path, I was in Silicon Valley last week, and PayPal are talking about the fact that they're having to pay software engineers straight out of university the equivalent of $280,000 as a starting salary, plus bonuses, plus equity options. So not a bad option if you've got children willing to go to the US and willing to go down the software engineering path. Now, a key debate in the market has been what's happening with yield curves, and there was an inversion of the yield curve on the 22nd of March. And why do we care about yield? Well, firstly, what is a yield curve inversion? It's an interest rate environment where long-dated bonds, you earn less for putting your money in a long-dated bond than a short-dated bond. And in this case, it was the 3-month and the 10-year bond yield curve that inverted. And if you look at the table on the left, 8 of the last 7 recessions in the US have been preceded by a yield curve inversion. And on average, a recession occurred 11.6 months after the yield curve inverted. So it has been a reliable lead indicator in the past of a recession coming in the US. Now, you've got Fed officials and ex-Fed officials like Rosengart and Janet Yellen debating the usefulness of a yield curve inversion at this point, given we are in unprecedented conditions given the liquidity in the market from the global financial crisis and the fact that the term premium is negative, so naturally you will get more inversions than you would have historically. But the reality is, for us as equity market investors, if you look historically, some great equity returns have been made still between the point of inversion and when you have entered a recession in the US. So for us, it's interesting. We're watching all the lead indicators in the US for further signs of deterioration, but at this point, the underlying economy in the US looks relatively strong. Now, the other point of debate is around China, and can what China is doing reignite growth globally? Now, why do we care so much about China? They're 18% of the world's population, 19% of global GDP, but they've been 36% of the increase in global growth since 2010. So what happens in China is important to the rest of the world. In 2018, China embarked on a deleveraging campaign, cracking down on the shadow financial system, cracking down on peer-to-peer lending, and you saw growth in China slow down as a result. Then on top of that, you had the trade war, and global growth and Chinese growth slowed down further. In reaction to this, the Chinese government has announced a range of stimulus programs. So you've had tax cuts, income tax, VAT, you've had infrastructure spending programs announced, and you've had reductions in the reserve requirements that the banks need to hold. So in total, if they look at it in terms of a measure, total social financing, which is a measure of liquidity and credit growth in the system, and there was 8.2 trillion renminbi pumped into the Chinese economy through the first quarter of 2019. In terms of how that feeds through into the global economy, there's usually a 6 to 9 month lag between credit impulse and when import demand starts picking up. So given they started this program towards the latter half of 2018, as we go through into the second half of this year, you should start to see economies that are the major beneficiaries of Chinese demand, such as Japan, Europe, Germany in particular, and the UK, start to benefit from those stimulus programs announced in China. Now, clearly, the debate point at the moment is, the trade wars, and it looked like, they'd had 5 months of ongoing negotiations, and it looked like we were heading towards resolution. But on the 5th, Sunday the 5th, Trump started tweeting again, and now he's gone and put up the tariffs. So they had 50 billion of goods that had a 25% tariff. They had 200 that had a 10% tariffs on them, and he's put that up to 25, and he's now threatening to add another 25% tariff to the other 325 billion worth of goods that flow from China to the US. So that is a detractor from. So our view was that they were certainly progressing towards a resolution, but that's taken a back seat at this point. Trump has tied himself very much to the US economy and to equity markets, so we think he is incentivized to get a deal, but he can't bring just any deal. I mean, NAFTA was a bit of a joke in terms of he changed the name but didn't get a lot done in that deal between the US and Mexico. So at least some deal we think he'll push towards. But China, having stimulated it, have really put themselves in a much better negotiating position, given their own economy is starting to see signs of benefit from that stimulus program. So the recent retail sales, housing activity, and industrial production numbers have been more positive. So we'll watch and see in terms of trade negotiations. The longer it goes on, the worse it is for global economy, for all the other countries around the world, because of the feed through. But our view is that Trump is very incentivized to get a deal, and will be pushing hard to get that done. If they don't do one and it deteriorates further, then China will announce another round of stimulus. In terms of the WAM Global portfolio, those two factors, so the US Federal Reserve going on pause and China having announced a stimulus program, as I said, have made us, we were cautious. We're less bearish than we were in November, and as a result, we brought down. We still had relatively high levels of cash, having only listed on the 22nd of June last year. So when the Fed announced that change, we brought down the cash from the 30% level to 11.5% at the end of April. But we have kept liquidity very, very high, so we can liquidate 96% of the portfolio in one day. So if the scenario that I've outlined to you doesn't play out, we can quickly add more cash to the portfolio if we choose to. And in terms of the actual construction of the portfolio, as you'll know, we have a wide variety of companies, small mid-cap companies that really fit the WAM process, which we've talked to you ad nauseum at presentations over the last 20 years, and that's really about identifying businesses that we think have strong industry positions, management teams that we rate. We can see earnings growth, strong earnings growth potential ahead, and a valuation we think that doesn't reflect that opportunity. And then we overlay this with needing to find a catalyst that we think will change the value, change the share price. If I run you through a couple of stocks that we own that are up there in the table. Aventum is one on the far right-hand side, second from the bottom. Now, this is a German-listed company. It's the Ticketek equivalent of Germany, Austria, Switzerland, and Italy. They have between 65% and 90% market share, depending on the market you're looking at. And this, in terms of ticking the boxes for us, as I said, the industry position very strong. The management team is very aligned with us. The CEO and founder owns 43% of the shares on issue, so clearly highly incentivized to work on, in our interests and his own. Secondly, in terms of the balance sheet, it's got a net cash balance sheet, 20% of its market cap in cash. And we think there's a nice margin story in terms of the earnings growth potential for the business as you transfer from buying tickets in a branch network to online. So we think there's a nice ongoing story there over time, and we think the valuation doesn't reflect that earnings growth potential, and we can see catalysts in the form of earnings beats and new business vertical optionality. So that's one we own in the portfolio. A second one I'll talk to is Bandai Namco. Now, this is a Japanese listed company. It's a toy and entertainment business. Again, so they've got a huge back catalogue of intellectual property of various names like Dragon Ball, Dokkan Battle. Now, these are Japanese-centric names that you might not know in Australia. Pac-Man, they're the owner of, so that an 80s brand. But they've got a wide back catalogue of names that they can roll out in terms of the rest of the world. And we think there's an enormous opportunity in China where the mobile gaming market is growing over 20% a year. This is a historically very conservative management team that consistently have beaten guidance over time. Again, a net cash balance sheet, so well positioned if there is any kind of economic downturn. And we think, again, it's got catalysts in the form of earnings beat potential going forward. So as I said, the other area that, in terms of the portfolio, we did use the sell-off in December to add some highly liquid global franchises like Alphabet, Booking.com, LVMH, just to bring down the cash. They rated on our process, and we thought it was an opportunity with the sell-off. But the ongoing, we're just looking for great ideas that really fit our process, and I will leave it there. I will hand over to Matt, who is the lead portfolio manager for WAM Leaders. Thank you.
Come from the other side. Great, thanks. Thanks, Catriona, and good morning, everyone. Today we're going to look at three topics, what I think are the most important to look at for the Australian market. So we're going to look at the three most important macro variables. Then we're going to look at China. Why is China so important for Australia? And then, given all these factors, how do you position your portfolio to make money? So when we look at macro variables, these are the most important things to consider at all points in time. It's the liquidity cycle. So how cheap is money and how available is money? Then the business cycle. So this is economies, how well they're going and where we are in the business cycle. And then we look at the political cycle. Are we in a stable environment or unstable? And how do we look right now? So liquidity cycle. This has been the main driver for the past decade since the GFC. A highly accommodative environment, pushing up asset prices. So liquidity, still very good. The US were trying to tighten. They worked out they couldn't and had to pull back. So again, liquidity, very good. So that's a big tick for equities. The business cycle. So as Catriona mentioned, predominantly driven by China. China accounts for over 30-odd% of global growth. So whatever China does, very important. And then we look at the political cycle. So political cycles are normally domestic focused. So you look at a political cycle, is the regime stable and conducive to equity markets or asset prices? In Australia, we've got some stability now, so that's a big tick. But recently, political cycles have become global. And by that I mean, what happens overseas has a direct impact on us, and what happens to China, which is our biggest trading partner, obviously has a very big impact. So if we look at all these, liquidity, a tick, business cycle is starting to improve, the China stimulus is going all right, but the political cycle, I'd say globally we're in a bit of a change at the moment. So we talk about trade wars, but this isn't a trade war. It's not a trade war. This is about a ruling party or a country and a rising power. So if you look over history, this has happened a lot. And there's been some great work from Graham Allison from Harvard. He came up with this term, the Thucydides trap, which is a term based on history. So back in the day, he observed some of these changes happening between the ruling and the rising countries. And it started back in Athens. So the Athenians were really worried about the rise of Sparta. And what happened was, and eventually a war happened, because they were so concerned about the rise, they thought their power would be taken away. So Graham Allison, he looked over the past 500 years. There's been 16 times a ruling country has been overtaken by the rising country. And 12 of those have ended in war, and 4 haven't. So this is something we've got to be highly aware of. This will go on for decades as China threatens US by overtaking them. So we might get a trade resolution, but this is something we've got to live with for a long period of time. And then you look at the characters. So when Graham Allison looked at why countries go to war, it's predominantly driven by a third party. So it's not the ruling and the rising, it's a third party. They cause the conflict and then they have to all go in. So we looked at the characters we've got at the moment. So if you look at the main characters, we've got Donald Trump, who's self-proclaimed a stable genius. You've got Xi Jinping, which fairly moderate, but then you've got Kim Jong-un, he's the third factor. So you could easily paint a scenario where conflict could easily arise. Of course, this is not our base case, but it's just interesting to look at the environment we're in. You've got a lot of characters in place that could actually cause this. So then we look at China. Why is China so important for Australia? And you can see it's their thirst for commodities. So China has a great appetite for base metals and industrial metals. You can see here for copper, 50% of global demand is from China. Seaborne iron ore, almost 70% from China. So you can see whatever happens in China has a big impact on Australia and also our budget. So when commodities do well, the Australian budget is repaired and we go into surplus. And that means we can spend more money domestically. So very important what happens in China. As Catriona mentioned, they have been stimulating. We're getting a bit of a fade now, so we're really watching what happens in China now. We think over the next few months, China will come back and start stimulating again. That's our base case. So how does Australia fit into this? You look at the demand or the production side. On the production side, Australia, very big producer. So for copper, number 5. But the main one for us is iron ore. As you can see now, the iron ore price well above $100 again. very good for the Australian economy, and very good for some specific companies. Also there you can see LNG, we're very big in LNG, which China has a great appetite for, and gold as well, great producer of gold. So you can see here, this is how you sort of play some of these thematics coming out of China as well. So we put all this together, and how do you position your portfolio? So our base case is global growth returns, and if that does return, all these flow-on effects happen. What happens is interest rates start going up, equities perform well, cyclicals start outperforming defensives, risk currencies like the Australian dollar go up, inflation picks up, and credit spreads and volatility narrow, which is great for asset prices. So this is our base case. Since we've been doing the roadshow, the probability of this playing out has actually gone down. So investing is all about probabilities, assigning a probability to the outcome, and then working out the upside and downside. So at the moment, the probability of this playing out looks like it's decreasing a bit, predominantly due from China pulling back on some of that stimulus they did, and also the trade wars, just causing some confusion around some of the supply chains and overall global growth. But it's still our base case. So if this is our base case, this is how you play it. So you look at emerging markets, because they do well in a growing environment. You look at global cyclicals, so companies linked to that growth at a global level. Commodities obviously do well as economies start building, and financials do well in a rising interest rate environment. So within WAM Leaders, this is how we position for it, and these are holdings that we have at the moment. So you can see here, we've played the iron ore thematic. That's proven to be a very good thematic for us. We've got companies like BHP, Rio, and Fortescue, all doing really well from the shortage of iron ore at the moment. Then you look across some of the other names. So Oz Minerals is one we've been playing, but copper is basically a proxy for global growth. That has been coming off a lot recently, so this has got us concerned a bit. The copper market, they joke around, copper has a PhD in economics because it basically predicts what's happening in the global environment, and at the moment it's coming down. So this has got us concerned a little bit. We're still thinking it's a good stock at the micro level, but we're just watching to see how this plays out over time. You can see here, QB and Computershare, we do have these. We've been reducing these positions because yields have been coming down. So all global yields have been coming down recently. It looks like domestically the RBA will cut rates. The RBA, if you look at their forward statement release this week, he pretty well said we're going to cut rates. If you look at the overnight index swap market, which is a forecast of what's going to happen, what people pay in the future, is pricing in 2 cuts for the Australian economy. So the terminal rate, what we think we'll get to in the forward market, is pricing around 0.88%. So you can see here the trajectory of Australian rates is definitely down. So again, this will hurt some of the financial companies, including the banks. So here's a case or a test case of how we apply this to the WAM Leaders portfolio. So Fortescue is a stock we've owned for a while. We bought this back when trade wars really started to peak, and a lot of these companies linked to global trade came off. So we began purchasing it in September of 2018. And what we do at Wilson Asset Management is we test our thesis all the time to work out if we go higher for the portfolio weight or reduce it. So we went up to China, talked to a lot of the steel mills. So iron ore predominantly used for steel making. And China, being one of the biggest market, you really got to work out what's happening in China. So for us, Fortescue, we went up to China. We were speaking with the steel mills. And the key thing for Fortescue is that it's got a low-grade iron ore versus the high-grade iron ore of BHP and Rio. So what happens is when steel mills don't make as much money in China, they substitute for the lower grade because it's much cheaper and they maintain their profit margins. So we got this trend where we're up in China, so we added to our position. Then you had the China stimulus coming out in January of 2019 and the stock re-rated. And then you had the Vale tragedy in Brazil where a tailings dam failed and effectively 98 million tonnes of capacity was taken out from stops put in place from the 1.3 billion tonne iron ore market. So a huge chunk of iron ore was taken out of the system and iron ore shot up again. And what we're seeing even this week is the flow-on effects in the tightening of the iron ore market. So again, this week, every day it's going up. You're getting that tightness. The port inventories in China have been decreasing, and they're having to buy on the spot market again. So we're seeing a lot of tightness here. And this trend, when we speak to the BHPs and Rios and Fortescues, they're saying this trend will go on for 2 to 3 years. So this seems to be, for us, a great space to be in at the moment. Now, if we're wrong, and this happens quite often, so if we are wrong and our thesis isn't correct with what's happening, we're going to go the other way. So what happens is equities start underperforming and the defensive start outperforming. Yield curves will remain flat, inflation remains flat, and currencies like Australia start falling, and the defensive currencies like the US dollar start going up. So this is how we play it within WAM leaders as well, and the sectors. So you go developed markets because they're safer, you go to gold, equities, and yield-sensitive assets because they do really well in low interest rate environments. Long duration assets, they're assets which have a long payoff. They do very well in a low interest rate environment. And your sectors around consumer staples, telcos and health, they perform extremely well too. So again, this is what we've got in WAM leaders because you always build a case in where you're not right because it's a probability that you're not right. So we've got to have stocks in here that at the micro level perform, but also at the macro level perform if we are wrong. So you can see here, we've got a lot of gold equities in the portfolio, so they account for around 5% of the WAM leaders portfolio. Now, gold equities perform well when the market falls or volatility increases, and we use this to great effect at the end of last year. So in November, we were in a lot of gold equities, and in December, a lot of these stocks were up 20 to 30%. So it can show us, even in a falling market, you can make money if you position right. And then on the other side, we've got a lot of yield-sensitive names. So Dexter, Sydney Airport, Goodman Group, GPT, expensive, but in a low interest rate environment, these stocks perform extremely well. So if you think we are in a lower for longer, you can stay in these names and they will perform. So again, this is another test case, I guess, of our portfolio and Evolution Mining. So Evolution is a gold miner, Australian assets, and we began purchasing this in September of last year. The reason why, when you look at gold price is predominantly determined by 4 factors: the US interest rate, the US dollar, the DXY, which is the broad-based dollar, oil price, which is like an inflation proxy, and volatility. And we looked at all these 4 factors back in September, and they were all very favourable for gold. And then we looked at positioning. So with commodities, you can look at how people are positioned in the futures market, and they quite often go into overbought and oversold levels, and gold was massively oversold. So we looked at this, and we thought gold equities, it was a very good hedge for us in case the market started to fall. We thought it was expensive, so we began purchasing this. So again, we purchased in September 2018, increased the position through November, and then when the market fell away, like I said, Evolution was up 27% for the month of December. In January, we lightened this position because it looked like the outcome of trade wars was going to be a good outcome, and volatility was decreasing, so gold price started to decrease. So we lightened this by 50%, and recently we began purchasing again in end of April, early May, because again, all the factors that we just saw back in September, October look like they're playing out again. So it looks like volatility might come back. You've got interest rates falling, which is positive, and volatility, I think, comes back up too. So now we're looking at the portfolio from an index perspective. We're not an index manager, but we thought we'd give you a snapshot of our positions versus their index weights. And these are the positions where we're most overweight. And like I was saying, the market is quite dynamic, so I think about 4 or 5 of these are no longer on our top weighting. So I'll point them out actually. The Tabcorp, Stars come down a bit too, QB's down a lot, and Computershare's down a lot. We still got all those gold names because, as I was saying, I think gold plays out well. But one I'll point out there that we quite like at the moment is Western Areas. We like Western Areas. The thematic around Western Areas is it's a nickel company. Nickel is very big for the use of electric vehicle batteries. BHP's strategy this week, they were very big on the outlook for nickel, and a lot of work we've done looks very supportive for nickel. But it's going to be 2 to 3 years before this plays out, I think. But the nickel industry in WA needs consolidation, and we think Western Areas will be a key part of this consolidation. So that's one we really like. And then another one we like, Aristocrat put out their result today. So the stock is up 8%, so we're very happy about that. But Aristocrat, very much undervalued, kicking all the goals. They do all the pokie machines, so a lot of people don't like it for that reason, but the fundamentals are in place for continued growth. So this is a company that we still continue to like. So that's it for me. I'll now hand over to Oscar Oberg, the lead portfolio manager for WAM Capital and WAM Research.
Thanks, Matt, and good morning, everyone. Today I'm going to talk about investor preferences for those companies that have offshore earnings, and then I'm going to talk about two companies. The first company is a technology company that's trading at a reasonable valuation, and the second company is the company in the midst of a turnaround where we see significant earnings growth potential over the medium term. Get me out of Australia. Now, this isn't a terrible reality TV show, but it's investors looking for growth outside of a weak Australian economy that is suffering from falling house prices and poor consumer sentiment. Now, despite the market rallying over 6% in the month of February, it was actually the weakest reporting season that we've seen since the global financial crisis, with average earnings per share being cut by 3 to 4% by analysts in the market. Now, leading this weakness were domestic cyclical sectors, such as building materials, property developers, retail and automotive, which each disappointed expectations. So with the economy weak, Australian investors are looking for those companies that have offshore earnings. And companies such as IDP Education, Breville, Altium and Appen have performed very strongly over the last 12 months, with these companies almost doubling in terms of their share price over this time. Now, this has contributed to the most expensive companies in the ASX trading at a price to earnings multiple around 34 times earnings, which, as you can see in the chart, is 40% higher than the 25-year long-term average. And what you can also see in the chart is the valuation of these companies are now higher than what they were at the time of the tech bubble in the early 2000s. So the likelihood that the Australian economy remains weak, which will put pressure on the exchange rate, we expect investors to continue to look for those companies with offshore earnings. Now, the challenge for us as undervalued growth investors at Wilson Asset Management are to find those companies that have offshore earnings, but most importantly, fulfill our research criteria and have a catalyst to see the share price re-rate over time. I'll let you take your pictures. And one such company where we see significant catalysts going forward is Infomedia. Now, Infomedia is the global leader of parts and services software for the automotive industry. It has over 80% of its revenue located outside of Australia in Europe and the United States, and over 95% of its revenue which is recurring. Now, the catalyst to buy Infomedia came from a change in Infomedia's new management team just over 2 years ago. Now, following a period of poor performance, Infomedia's new management team decided to invest heavily into its parts and services offering to take market share. Now, we followed the company very closely at this point in time, and after we received positive industry feedback from our contacts, we decided to purchase shares at the share price of 80 cents back in March 2018. Now, most importantly, at the time where we bought shares in Infomedia was when the technology sector globally was really starting to fire up. And we thought that if Infomedia was to show strong momentum, was able to beat earnings expectations, then the share price should increase quite strongly as a result. Now, thankfully, what we've seen over the last 2 half-yearly results is that Infomedia has beaten earnings expectations, and with the tech sector globally continuing to show strong momentum, the share price has increased strongly as a result to $1.90 today. Now, going forward, we still see significant catalysts for the Infomedia. We expect the business to beat earnings expectations at the upcoming August result, and we also see the potential for earnings accretive acquisitions. So we're still very positive on this business. Now, while we do expect investors to continue to look for those companies with offshore earnings, it's important not to take your eye off the domestic economy because opportunities will always arise. And one such opportunity that we saw just under 12 months ago was Myer. That's very interesting. That's the most positive response I've had from a crowd this roadshow. Maybe you are all believers, who knows? Now, the catalyst to buy Myer we talked about back at the November roadshow. And this was, of course, a change in the Chief Executive Officer, John King, and the significant cost savings and efficiency savings that we could see within the business that could drive profitability over the medium term. Now, I'm pleased to say in the last 2 half-yearly results that Myer's surpassed even our positive expectations. And in fact, in the last half-yearly result, it was the first time in 8 years that Myer's actually delivered earnings growth. Now, going forward, we continue to see cost savings through this business. We expect around $30 million of rental savings that can be achieved by consolidating floors within a shopping centre, say from 4 floors to 3 floors, and also by closing underperforming stores. We also see around $12 million of head office and procurement savings that can be achieved. Now, we expect just under 50% of these cost savings to be reinvested within Myer to help reinvigorate and drive top-line sales growth. And this will be in the following 3 categories. That's the quality of the Myer brand, the quality of the store, but most importantly, the service that you receive in the store, which is something that has been lacking for some time. Now, if we put all of this together, we believe that Myer can achieve a profit of around $55 million in the next 3 to 4 years. Now, what's most important about this is the fact that this is 60% higher than analyst projections out there in the market. So look, we remain very positive on Myer over the medium term. Now, for all you non-believers out there, and I reckon it's a lot of you, I'd like to tell you about a story about my wife, Sophie. Now, as I often like to do at Wilson Asset Management, I like to help out our investments. So I decided for Christmas to buy Sophie a Christmas present, which was a Myer gift voucher and a free personal shopping experience. Now, you should have seen the look on my wife Sophie's face when she opened up her Christmas present on Christmas morning. She looked at me and she said, "Oscar, a gift voucher and from Myer? Are you serious?" Now, I'm pleased to say that Sophie loved her time at the personal shopping experience. She spent double her voucher and she's told all her friends about it. And in fact, Martin's wife, Eda's gone to the personal shopping experience and had a great time too. So the point of the story is if my wife can be convinced on Myer, then so can you. So in conclusion, while we do expect investors to continue to look for those companies with offshore earnings, at Wilson Asset Management, we'll be looking across all sectors of the market because you never know when an undiscovered gem such as Myer may come across your desk. I'd now like to pass it on to Lead Portfolio Manager Martin Hickson to talk about WAM Active. Thank you.
Thanks, mate. Well done. And I can confirm Eda also loved her personal shopping experience. If you don't believe me, you can ask her yourself. She's here today. She's the lady carrying around the 6-month-old child. It's funny, she said today she wanted to come and see me present, but I think really she just wants to go back to Myer after this finishes. So good morning, everybody. Today I'm going to be talking about 3 things. I'm going to be talking about the recent volatility that we've seen on the day a company reports its results. I'm going to be talking about a company whose share price is up 100% this calendar year to date. I'm going to be talking about a micro-cap stock, which we think can continue outperforming the market over the next 12 months. So firstly, the volatility. As the chart above shows, over the recent reporting seasons, the volatility on the day a company reports its results has been steadily increasing. During the recent February reporting season, companies' share prices moved by around 3.8 times what they would normally move by on a typical trading day. Looking at the ASX 200, over 30% of companies saw a share price move either up or down by more than 5%. So why is this occurring? We think it's due to a combination of things. Firstly, the number and the experience of analysts working on the sell side for stockbroking firms in recent years has been declining, in our opinion. This means that when a company reports its results, there's a higher probability that the result is going to be different to consensus numbers and different to what the market is expecting. Secondly, there's been a large increase in the amount of quantitative funds in the market. And these quant-style funds will buy or sell a company's shares purely on whether the company's result has beaten those consensus expectations. So how are we reacting? Well, within the market-driven portfolios, one of the key strategies that we utilise is trading around company results and earnings season. We spend a lot of our time in January and July going into results, going through our notes, talking to other analysts, updating our models, and trying to come up with new trades where we think the company's results will be higher or less than what the market's expecting. And if we do this correctly, we are generating higher levels of alpha and performance over these reporting periods. The next slide has the top market-driven stocks. These are companies that we hold in WAM Capital, WAM Active, and WAM Microcap. I won't talk to it in detail. These names appear in our monthly updates that we release to the market every month. So the company whose share price is up 100% this calendar year to date is a company called Appen. It's an IT company. Some of their largest customers are the big global technology companies, businesses like Facebook, Microsoft, Google. And what Appen do is they help these organizations improve their algorithms. They provide data so the companies can improve their artificial intelligence tools. So an example of what Appen do is if you've ever been on Facebook and you've been on Messenger talking to somebody about buying a new car, and then over the coming days a whole heap of Facebook ads pop up trying to sell you a new car, it's likely that Appen have helped Facebook improve and build on this algorithm. Appen's been a very successful business since it listed. It listed on the ASX around 4 years ago at 50 cents. More recently, the shares were trading at $25. So it's what some people would call a 50 bagger. We've traded Appen 7 times over that period, and we've traded it on the market-driven side due to its very, very high valuation. And the chart above shows why Appen has been so successful since its IPO. If you look at the maroon bar above 2014, what that represents is the revenue from all of the customers which Appen acquired in that year. If you then look forward to the maroon bar next to 2018, that maroon bar is now 5 times larger. So what that means is Appen is now generating 5 times the revenue from those customers that it acquired 4 years ago. And so as they continuously acquire new customers, the revenue that it generates and the earnings it generates grows exponentially. And that's why there's been such a significant re-rating in Appen's valuation and why it continues to deliver strong results and earnings upgrades, beating its own forecasts. The company or the microcap stock that we think continues outperforming is a business called PWR Holdings. It's one that we hold in our microcap fund. They're a manufacturing company, so they build cooling systems or intercooling systems for cars. It's an Australian company based in Brisbane. The CEO and founder, Keys, is still very aligned with shareholders, still holds 30% of the company's shares. As you can see on the chart, 60% of their revenue comes from the motorsport industry. So as an example, they've got an 80% market share in Formula One. So they're building these very, very high-performing, highly specified cooling systems for those cars. We first started buying shares in PWR back in May last year. And there was 2 key catalysts why we started buying shares. The first was that they were pushing into the OEM space, or the original equipment manufacturer space. And that basically means just large global car manufacturers. Since then, they've been successful in pushing into that space. That area now represents around 8% of the company's revenue. They've won contracts with businesses like Jaguar and Rolls-Royce, where they build these cooling systems for their very, very high-end, short-run cars. The other key catalyst was that they were pushing into the United States. They were doubling the size of their manufacturing facility over there. And we thought that over time, as they filled this extra capacity, that would lead to strong revenue growth and earnings upgrades. And that's what's occurred. Currently, PWR's earnings are growing at 20%. In our opinion, it's still trading on a very attractive valuation. And so we believe that the company's shares can continue re-rating over the coming 12 months. So today I've spoken about 3 things. I've spoken about the recent volatility that we've seen over company reporting seasons and how we're reacting to that. I've spoken about why Appen has been such a successful business since it listed on the ASX and why we've traded it on our market-driven side of the portfolios. And And I've spoken about why we think PWR can continue outperforming. I'll now pass over to CEO Kate Thorley to conclude.
There we go. Thanks very much, Martin, and good morning, everyone. So this morning you've heard from Geoff and the investment team about the challenging investment market that we're facing. And in these current markets, you know, the importance of having a very consistent and robust approach to investing. And the lead portfolio managers have demonstrated that robust approach in the various stock stories that they've talked about this morning. You've also heard Geoff talk about the franking issue and the stance that we took in terms of wanting to make a difference for our shareholders, and what a great result that was. We also like to make a difference at Wilson Asset Management in the support that we give the two future generation investment vehicles. Geoff founded FGX and FGG in 2014 and 2015. The presentation for these two vehicles will be held straight after a short break today, so I'd encourage you all to stay for that. Also following lunch is the Future Generation Investment Forum, and everyone's got this in their bag, which outlines the 8 best fund managers. It's going to be a great lineup this afternoon. They'll be pitching their best stock stories to you. And last year, the number one stock pick was up over 50%. So I'd encourage you to stick around for the forum. We'll also have Tony Boyd from the AFR interviewing Hamish Douglas from Magellan. And there's also a surprise guest as well. So please do stay for that at 1:45 today. Also, the team at WAM want to make a difference in the community. And there's a team of 32 of us. Most of us are here today. And we have an initiative called Wilson Asset Management Gives. And the investment manager gives each of the team members $10,000 a year to donate to charities of our choice. And we ask that we all talk about it at the various team breakfasts that we have during the year. And it's actually quite powerful, some of the stories that you hear. As an example, last year, I was very fortunate, myself and a few others from the office went to the Darlinghurst Public School, and we saw a primary ethics class. We were able to sit in on the class. It was run by a volunteer who was teaching these children in the class about ethical issues and how to have a discussion about them and critical thinking around these issues. And I was just blown away by it. And it's probably because I'm a mother of 4-year-old twins that it really sort of struck home. So that's just an example of something that I chose to support last year. Something else we're really passionate about at Wilson Asset Management is education, and we're really pleased to be announcing the launch of the WAM Academy later this year. This will be a number of educational modules that we'll release, and it's to share our passion for the markets. It's also to help our investors and their friends and their family and their grandchildren to increase your knowledge and help you better understand investing. This is a sneak peek of what you can expect.
I remember as a teenager, most nights, Dad would sit and he'd read the newspaper, and he spent an enormous amount of time just looking at one page. And it always perplexed me. It was a page with a whole lot of numbers on. And I remember asking him, what was he looking at? And he said, this is the stock market. And I said to Dad, I'd like to buy some shares.
So that now concludes the formal part of the presentation. I'm going to invite our speakers back up on stage. We'll have a short discussion before opening up to questions from the floor. Thank you. Great, we'll get started. So just to each of the panel, when we're investing, you don't always get the stocks right. Can you talk about a stock, one stock in particular? I know you could be here all day, but one stock in particular that hasn't worked out and something that you've learnt from that particular investment. Oscar, do you want to?
Yeah, no worries.
You go.
Yeah, believe it or not, we make a lot of mistakes. No, the company that was a bad one for us on the research side of the portfolio was GTN. So these guys fly helicopters around and provide traffic reports. You know, think Vic LaRusso on the radio. In fact, I think he's a major shareholder from memory. And basically, it was a good company, generates strong cash flow. Had their AGM update in September. They said July and August had been quite good months, but September they've seen things fall away. Now, we gave them the benefit of the doubt. The stock was quite cheap at the time, and then, of course, what happened was the Australian economy fell into a bit of a hole. Media advertising spend declined, and then we started to try and sell the stock, and of course, we couldn't sell enough. And then GTN delivered us a Christmas present on Christmas Eve and had a huge earnings downgrade. So the lesson there was when management, through their commentary in an AGM or presentation, give you a little hint that things are getting worse, it's generally pretty bad. So we should have sold it at that point.
Great. Matt?
Yeah, we've got a similar one. So this company, Sims Group, we've got a bit of a, you can have a love-hate relationship with certain companies. We've got a hate relationship with this company. We always seem to get it wrong. So Sims Group, they do recycled scrap metal and sell it to steel furnaces, so electric arc furnaces to make steel. So very cyclical business. This company historically could outperform in the environment we were looking at it. So it was going through, we bought it in June, July of last year. Iron ore price was going up, so scraps linked to iron ore price. All the end markets seemed to be going well. Then Turkey, which is their largest customer, began to have a lot of political issues, and the economy deteriorated, and their currency deteriorated rapidly against the US dollar. At a point in time, I think it got to 7-1 from down to around 3.5, 4. So basically fell by half. And this was a warning sign for us, which we went back to the company and various contacts, and we were like, is everything all right in Turkey? Are they still buying? And all the answers we got back were yes. So companies generally like to be optimistic until they have to fess up. And then it was probably about 2 or 3 weeks later, they came out with a massive profit downgrade. So we got the warning signs, very much like Oscar, did a little bit of work around it and thought maybe it wasn't as bad, but again, you really got to listen to those warning signs. When you get a glimpse about things not going so well, a company will hold out until they have to fess up. So the lesson here is observe the end markets, and if they deteriorate, get out.
Thanks, Matt. And Martin?
For me, one on the market-driven side is Magellan. So we started buying shares in Magellan, the fund manager, back in October and November last year. The reason why, or the catalyst, was that their performance had been very strong, and this was leading to a large amount of new funds flowing into the products and the funds that they managed. And also the Australian dollar had been falling. So we thought that the combination of these things would lead to an earnings upgrade in February. So we bought 1% position in WAM Capital, 2% in WAM Active, and then we sold out of that position in December when the market fell, because we thought that there was going to be a significant risk to our capital, given fund managers generally underperform the market in a falling market. The mistake we made, though, was not buying back in January when the Fed pivoted away from rate increases and quantitative tightening. And so that was the mistake. We should have bought it back. And since that point, Magellan had a very strong result in February. And since the start of this calendar year, the share price is up 70%. So it's cost us by not owning it. So that's probably one of the biggest mistakes we've made over the last 6 months.
Thanks.
Mistake on the WAM Global front was a French-listed mid-tier luxury company called SMCP. So it has the brands Sandro Mage, Claude Perrault, and as the global economies were slowing through 2018 and as the trade war rhetoric picked up, we'd only just begun the fund, but we adjusted a lot of the positions, anything that we thought was really going to be trade war affected in the auto area, etc. But we held on to SMCP because we thought, they could continue to deliver on the numbers they'd put out there, etc. But the share price fell. And the reality was, yes, they did meet all the numbers they'd put out there, but retail is a tough area to, doesn't hold up well in an economic slowdown, and throw on top of that that a large part of their business is in France and Paris specifically, where there are the yellow vest protests. So the share price actually derated. So they met the earnings expectations, but the multiple that was placed on the stock really got hit. So in hindsight, we should have sold it when we sold the rest of the things that we thought were going to be trade war affected.
Great, thank you. Now, Geoff, can you talk to us about the dividends in terms of how the LICs pay dividends and what the current profit reserves are for each of the LICs?
Yeah. Thanks, Kate. How our listed investment companies pay dividends is obviously we invest in companies and we can hold various amounts of cash depending on the opportunities we see to buy undervalued growth companies. But the companies we invest in, we receive dividends, but also, and then that makes up part of the dividend we pay out to our shareholders. The other part is profit we make. So we're different to a lot of the older LICs, which they receive dividends and pay them through. We receive dividends and pay them through, but we also enhance that dividend by any profit we make, and that's why we've been able to give people a higher yield over time. And really our dividends, part of our dividends relies on what profit we make. So the important thing to look at is the profit reserve, and in terms of, I wrote down the numbers, in terms of the profit reserves for the various listed investment companies, and this is going down in size. WAM Capital's got, as of today, got 7.6 cents in its profit reserve. So we need a profit reserve plus we need franking to pay a dividend, and we try to pay as much of our franking out. Leaders is 8.4 cents. WAX is 28 cents. That's WAM Research. WAM Global 5.6. So it's we're getting a bit of a profit reserve in Global. So obviously I'm one of the directors, but I'd assume the directors will have to decide when we get to June whether we start paying a dividend in Global. Microcap's got 19 cents, and WAM Active has 4.7 cents.
Great, thanks, Geoff. I might stay with you. Can you give us an update on Blue Sky? Yes.
Blue Sky, the manager, has gone into administration. Blue Sky, the listed investment company, BAF, which we put a proposal in the latter part of last year to take over the management of it. And the reason we did that was because they have very interesting alternate assets. And we still think there's a significant opportunity there. At the moment, we're communicating with the BAF board is very supportive of us managing that pool of capital, and we're communicating with Oaktree and Cordamentha, the administrator, about taking over the management there. I know personally, I tend to have my money in equities, both domestic equities and global equities. Now that we have the global products, what we all thought at Wilson Asset Management, there's a great opportunity to have another stream that's alternate assets. You look at the Future Fund. If you add all their alternate assets, I think 46% of the pool of capital that they manage is in alternate assets. We're still hopeful. One of the good things is it's trading at an enormous discount to NTA. Yeah. So let's see what happens. We either take over the management of BAF and manage it, investing in alternate assets, and with Adrian Sue. Actually, Adrian, do you just want to stand up? If anyone wants to talk about the alternate assets or BAF, please talk to Adrian. He's our lead PM with alternate assets. Great background in private equity and the alternate asset space. So yeah, we're pretty excited. We think it could easily be a $1 billion plus LIC.
That's great. Thank you, Geoff. Matt, I might get you to talk about the banks.
Sure. Pretty eventful week for the banks. So good day Monday. Then Tuesday, APRA came out with some changes to the way banks assess loans. So the banks used to self-enforce a 7.25% interest rate assessment for all loans. APRA level was 7%, but APRA came out and said basically, banks, you can set your own limits. But the one caveat is you've got to have a 2.5% buffer on the current market rate. So APRA are trying to get some credit growth back into the system because banks' earnings are linked to credit growth, and we've had a really poor 12, 18 months of credit growth, which is hurting banks' earnings. So the environment for banks is not that fantastic. Regulatory costs, each of them are carrying about between $150 to $300 million of extra costs at the moment due to all the issues around Royal Commission and a lot around systems. There's been $2.8 billion of remediation payouts, so it's been a tough period for them. The only way you can get good growth back into banks is getting credit growth through the system, and at this point in time, this new policy change, unsure if it will have an impact, potentially could have a positive impact. We've really got to go and see the banks to work it out. And if we go through relative preference, so NAB for us looks like the cheapest bank and the one with the most potential. The problem with NAB though is it looks like it's had potential for 20 years and hasn't delivered. So new management, I think the new management that potentially coming in, the talk is Rob McEwen from RBS coming in. It hasn't been appointed yet, but that looks like a candidate. He's really got a great banking background, so NAB is number one. Then CBA looks pretty good to us too, biggest deposit base, good franchise, excess capital, so there is a chance they pay a special dividend or do a buyback, because with their life sale and the Colonial First State, the global sale, they'll have about $8 billion of excess capital, so they're in a great position. And then Westpac would be number 3, and then ANZ is the lowest ranked, just because the franchise is the weakest. And there's a couple of things worrying us about ANZ on their disclosure. They have around 6% negative equity in their mortgage book. That's a bit of a concern, and they've got in trouble with the New Zealand regulator as well around their models. So just a little concern around ANZ.
Great. Sorry, I was looking at the babies in the room. There's a few of them. Geoff, I might hand over to you now. In today's AFR, they mentioned that you have supported the Uluru Statement from the Heart. Can you talk about what that is and why you've supported it?
Yeah, I mean, anyone is of course free to read the article. It's a statement that the Aboriginal and Torres Strait Island descendants delivered to the Australian people a couple of years ago, and what it does, it sort of acknowledges, and the logic is to acknowledge from a constitutional perspective, to give them a voice, and we know they've been here for 60,000 odd years, and John Wiley contacted us, and he's been very instrumental in terms of trying to have it on the agenda from a business perspective, and asked if we'd sign a letter that was sent to, in theory it was going to be before the election, both sides of politics, and yeah, it's really giving the First Nation people a voice. And I think the last sentence of the statement, they ask all Australians to walk with them, and to we as an organisation, Wilson Asset Management, think that it's important.
Great, thank you. Thanks, Geoff. Oscar, I might hand back over to you. Can each of you on the panel talk about a stock that you still see upside in, or that you like for a particular reason?
Yeah, thanks, Kate. The company on the research side that we like, which is very much a contrarian view, you probably, looking at a 2 to 3 year view, is AP Eagers. The ticker is APE. So these guys are the second largest car dealer in Australia. Now, it's a horrible new car sales market at the moment. New car sales off around sort of 10% with the weak economy. But the reason why we like it is AP Eagers is announced a takeover about 6 weeks ago of the number one car dealer, or the largest car dealer in Australia, which is AHG. AHG has been a terribly run business for some time, and I think the simple thing is to look at AP Eagers' profit margins versus AHG. AP Eagers does 4% profit margins, AHG does 1.7%. So we see a whole lot of cost synergies with this tie-up. AP Eagers has got fabulous management, and so we think there's a number of announcements or catalysts around increasing these cost synergies over the next couple of years. There'll be divestments, and then hopefully when you get to the end of that 2 to 3 year period, new car sales will start increasing again. So we quite like it, and we own on the research side of the portfolio.
Great, thanks, Oscar. And Matt?
Yeah, I'm going to go with a highly speculative stock. I talked about it in the presentation, Western Areas. So we live in a very short-term market at this point in time. It's very much day-to-day. So this one's more a medium to long-term thematic. And for me, there's a big gap in the market between the mine and the end user of the batteries, so the car manufacturers. And the supply chain, because it's so new, there is no supply chain in place. So what I think happens over the next few years is that space will get filled. And when you produce electric vehicle batteries, you need all these components, nickel being a very important one. For us, Western Areas have a higher grade nickel. They produce nickel sulfate. For me, this company won't be around in 5 years' time. It'll be acquired by somebody. So I think not only at the micro level, the thematic is good, but I think this is a company. You've seen the acquisitions in the space already, led by Wesfarmers, who've done Lynas, or in the process of trying to get Lynas, but also Kidman Resources, which Wesfarmers own. Western Areas own 6% of Kidman. So you can see this whole space will get consolidated, and for us, Western Areas is a high quality company.
Great, thanks, Matt. And Martin?
For me, it's a stock that we hold in our micro-cap portfolio. So given it's a micro-cap, it is higher risk. But it's 5G Networks. The code's 5GN. Very small company, capped at $50 million. The name's a bit deceiving, that they don't operate in the 5G mobile space. They're an IT services company. So what they do is they help manage small to medium businesses' IT infrastructure. So an example of what they do is us at WAM now, we no longer have our servers in the office. We've got an IT services company that manages our IT, and all of that IT infrastructure is held in the cloud, which is in a data center that's located off-site. And that's basically what 5G Networks do. They've provided guidance or an aspirational target to achieve $80 million in revenue beyond FY20 and $10 million in EBITDA. And so if they can achieve that, it's trading on a very cheap valuation, 5 times EBITDA, which would be a price to earnings ratio of less than 10 times, so very cheap. They've also recently raised money. They did a placement back in April, which we participated in. So the balance sheet is very strong, and they've got capital to deploy into acquisitions. So that's another catalyst that we think will occur over the coming years, that they'll acquire and consolidate the industry. So that's one that we like in the micro-cap space.
Thank you. Catriona?
One we still like at WAM Global is one I've talked about previously at a the November presentation, I think, is Entertainment One. They're the owner of the kids franchises Peppa Pig and PJ Masks, amongst other content that they own. We think the value of content is only increasing today. The pipes are reducing in value in terms of, pay TV providers, etc., with the competition from Netflix, Apple TV, Stan, etc. But the content is still very valuable, and they make their money from actually selling the merchandise. So the content gets the customer in, and then the kids like mine hassle you to buy all the merchandise, and they make a 6% royalty on that. And that family business of theirs is growing 28% a year currently, and they're benefiting from the fact that it is the year of the pig in China. So they're doing very, very well there, and we think trading on 14 times with that family business growing so strongly, we think it's a good opportunity.
Great, thank you.
Yeah, and I'll just stick to my knitting. I'll buy Leaders at a 7% discount, and I'll buy Global at a 10% discount. And I know there's a number of shareholders here that were in WAM Capital in the early days. I saw John Plummer and Eric Brochelle, and I know there's others. And they all remember, and we were chatting a little bit out there, they remember when we floated WAM Capital. We floated at $1, and in the first year we paid 12 cents fully franked, and in the second year we paid 14 cents fully franked. And it wasn't until the third year that over that period of time, we traded at a 20% discount to NTA. And it was only in the third year that we got to NTA. And what we found is over the first 2 years, 35% of our shareholders sold. And why do they sell is because, okay, an IPO turns up, you're putting the money in, you think you've got a reason why you're putting the money in, something changes, or there's a bit of uncertainty and it knocks your confidence and you sell out. And I think that's what happened with Global. The latter part of last year when the market was very volatile, it hasn't even been, we haven't even been managing the money for a year. So to me, it's in that period where the share register is tightening up, and as the share register tightens up, then and the people that don't fully understand what they've invested in, then they sell out. In terms of the performance, I mean, last month Global was up 5.3% the portfolio, and the market was up I think 4.5%, and this month you're ahead of the market as well. So to me, I'm going to stick to my knitting.
Very good, thank you.
Thanks.